Reserve ratio (CRR) is the percentage of deposits that banks are required to hold as reserves with the central bank. Statutory Liquidity Ratio (SLR) is the percentage of deposits that banks are required to maintain in the form of liquid assets such as cash, gold or government securities. CRR and SLR are important tools of monetary policy as they regulate the liquidity in the economy. When the central bank increases the CRR and SLR, banks have to hold more money as reserves and maintain more liquid assets. This reduces the amount of money available for lending and slows down credit demand. Conversely, when the central bank decreases the CRR and SLR, banks have to hold less money as reserves and maintain fewer liquid assets. This increases the amount of money available for lending and stimulates credit demand. This can lead to higher inflation and economic growth. However, if the credit growth is too high, the central bank may increase the CRR and SLR to reduce the money available for lending and control inflation. This can slow down economic growth. Recent examples of the impact of CRR and SLR include the Reserve Bank of India's decision to reduce the CRR by 100 basis points to 3% in 2020 to increase the liquidity in the system. This was done to support economic growth during the COVID-19 pandemic. Similarly, in 2019, the European Central Bank reduced the SLR requirement from 2.5% to 0%, which allowed banks to use the freed up funds for lending and stimulating credit demand in the economy. In summary, CRR and SLR are important tools of monetary policy that regulate the liquidity in the economy and impact credit and demand, with implications for inflation and economic growth. Recent examples show their use in supporting economic growth during challenging times.